Alright friends, I'm back with another video. In this video we are going to look at tools for technical analysis. Now whenever you open your trading platform, there are a number of tools on it. There are candlesticks, there are moving averages, there are oscillators, there are Fibonacci numbers on it, and other things. But then today we want to go through some of the tools I use in my technical analysis. Now the first one is candlesticks. Now these candlesticks were developed by the Japanese so many years ago, and by looking at the candlesticks or the candlestick patterns, we are able to know whether the market is heading, whether the market is heading up or down. And so let's just open the charts and look at some the candlesticks generally. We'll come back to this pictorial view here, but let's look first at the charts. Alright, so that is the chart in front of us. Now first and foremost, let me say that what you see on the chart currently is what we call the candlesticks. For every chart you might have bar charts like this one, bar charts like this one, or you can have line graph like this one, but most traders these days use candlesticks. Now another thing you need to know is that each of these bars form within a particular time frame. Now I have chosen the 1 minute time frame, so it means that these bars will form within 1 minute. Okay, then we have 5 minutes, we have 15 minutes, we have 30 minutes, we have 1 hour, each for daily. Now on the daily, it means that the candle you see here formed within 24 hours. Then we have weekly, then we have monthly. Well, let's go back to our pictorial views and learn something about candlesticks before later we come back to the charts. Now we have two types of candlesticks. We have the bearish and the bullish. When we talk about bearish, we mean that it is the action of sellers, because in the market we always have buyers and sellers. So bearishness means that, or bearish candle means that the sellers are pushing prices, or prices are moving from top to bottom, or their prices are moving lower. Okay, now so for a bearish candle, and for every candle also, we have the open price, we have the close price, we have the high, and we have the low. For every candle you have the open, the close, the high, and the low. For a bearish candle, price will open from the top, just like you've seen it says open here, then it will close near the bottom, then we have a high and we have a low. Now when we look at this candle, basically what it says that price opened here, then we moved up to this level before the sellers pushed it down to this level, then eventually it closed here. So that's our bearish candle. Just understand that bearish candle means that prices are moving lower. Now when we come to bullish candle, it is the opposite of a bearish candle. In a bullish candle, prices are moving higher, and so the price will open lower, then it will close higher. Okay, that's why we have the open at the bottom, unlike in the bearish one. So we have the open, the close, the high, and the low. So in this candle we had the open here, price tried to push downwards, but then the buyers came in and pushed it all the way to this high, then eventually closed like this. So basically this is how candles are. The more we do technical analysis, you see how they work. Now I want us to quickly look at the most talked about or most famous candlesticks. There are so many candlesticks patterns with a lot of names. We have the mariboso, the dojis, the engulfings, the hammer or the pin bars, the railway tracks, etc. But I have chosen about 3 of them that are normally used or normally mentioned by many people. So let's look at the first one. The first one is the doji. Okay, the doji basically is an indecision candle because the price opens and closes at the same place. It just tells you that there was a struggle between buyers and sellers and none of them was able to overpower each other. That's why it is like this. It's an indecision candle. Now when a candle like this forms around a strong support or resistance area, it could indicate that, for example, if it forms around a strong support area, it could indicate that the buyers want to take over the market. If it happens also at a strong bearish area, it could mean that the sellers are taking over. Okay, so basically that's how it is. We'll see more of that later. Now the next one that people really like, this candle, the pin bar. The pin bar tells you, for example, we have the bearish pin bar and the bullish pin bar. Now you can see that it has a long wick or shadow, then there's a small body here, then a small wick. Now this, when you see a candle like this, it basically tells you that we opened here, went all the way up, but we couldn't close up here. Then the sellers or the bears pushed price from the top down to this place, then it closed here. Therefore it tells you that there's selling pressure mounting on the market, okay, or on the candle. So that is what it means. Now when there's this kind of selling pressure and this happens in a strong probability zone on the chart, then it can indicate massive selling for traders, and traders could get in and make some good money out of it. On the other hand too, we can see that this is a bullish pin bar or a hammer. Now the bearish one is also called an inverted hammer. Okay, so the bullish pin bar too, we see that the price opened here, okay, went all the way down. Wow, let me go back to the image. Yes, went all the way down to this place, but it couldn't close. Then the bulls came in and pushed strongly and went all the way up here, then the price closed here. So that is it. When this also forms around a strong support area, it could indicate massive buying or massive rallies or bullishness in the market. Now another candlestick pattern that is really popular is what we call the engulfing bar. Some people call it the railway tracks. Now you can see that there are 2 candles. Initially you realize that the bulls, actually on most charts, every green candle indicates bullish action and red candle indicates bearish action, or the green candle is for buyers and the red for sellers. So you realize that the buyers were trying to push price, but then eventually the sellers took over and overpowered them. So this bar has engulfed this, kind of overshadowed it or overpowered it. And when this normally happens, it could indicate lower prices on the chart. Now for bullish engulfing too, you realize that there was an initial sell candle there, then eventually a buy candle comes to overpower the sell candle. Then normally when it happens, it could indicate higher prices on the charts or for traders. Now that's a little bit about candlesticks. Another tool we use is trend lines. Okay, trend lines. Now for trend lines, let me go and onto the charts and explain how it works. Let me come to a lower time frame. Normally when the market is moving up, we can use trend lines to track the movement like this. That is the trend line. It's a tool. I picked it. This is where I got the tool. Let me close it and pick it again. This is it. Draw a trend line, then you pick it, then you draw it. So you realize that the market has been holding along this trend line. That is it. So normally you can use trend lines to track possible areas the market can come in and bounce. You can come in and bounce there for continuation. Okay, so you use it to track the, in this case this is an up move, a rally or a bullish move. So it goes up, comes to it, then you can buy it here. You can buy it and be making money. So when the trend line is pointing up like this, we call it a bullish trend line. Then also we have also a bearish trend line. That is when it is pointing down. Let me see if I can get or draw a bearish trend line for us. Let me see if this would be a good example, like this one. Let's not, we had two touches. Let me see, go back a bit. Okay, we can draw one here. We can see that there is a bearish trend line. Yes, so when the market started here, when the market started from the top here, you realize that prices were bouncing along this trend line. Okay, well, so anytime the price comes close to the line I've drawn, you can look for a sell, and you realize that when the bounce happened, it dropped. So that is basically how trend lines behave. In later videos I'll show you how I use trend lines in technical analysis. Well, let's go to the next tool. The next tool is called Fibonacci. Fibonacci was actually developed by a mathematician from Spain. Well, is it Rome? Yeah, actually no, from Italy. From Italy, yes. So for Rome. So in forex trading, we use the Fibonacci numbers for both retracements and for getting targets, what we call Fibonacci expansion. So we have Fibonacci retracements and Fibonacci expansion, but I usually use the retracements. So let me show you how it is. It has some numbers on it. It has the 23%, the 32.8%, the 50%, the 61.8%, yes, and other numbers. But the popular ones are the 38.2%, the 50%, and the 61.8%. Okay, and it helps us to identify potential support and resistance levels. So let's just say we're drawing Fibonacci for our chart here. Let me remove this trend line. We're in this downtrend, so if it's the market is coming down, we draw it from the top to the bottom like this. So that's the Fibonacci retracement, and you can see that the prices will bounce around these areas. Let me see. In this market, not everything is. Let me just erase this. Let me put the Fibonacci here for a bullish something. Okay, so that is that. When the market see that when the market let me add some other numbers. I'm coming. Let me do a quick addition. Fibonacci properties. Okay, add. Guys, I'm coming. I just want to add adding some Fibonacci numbers that is not already on the chart. It's not part of the customized this thing. And I'll add another one. 0.79, that is a 79. Okay, so yes, so you can see on this chart right now that when the market was moving, see it found support around the 79% retracement, then went up. That's how Fibonacci. Let's see. Normally you take, let me remove it again and you draw it again. We take the lowest point to the highest point of, we call this a swing. We'll go into that later. Then we'll look at the retracement. So it comes into, let me draw it well. And that's the highest point. Yes, it comes into a level there, then it finds support, then moves up again. And when it moves up, this will be eventually become the low, then this will be the highest point again. And you realize the market came to the 61.8 level. So that's how we use Fibonacci. Okay, so when in a trending market, anytime there are pullbacks or retracement, you see that we went up and we were coming down. You can use Fibonacci to know the possible reversal zones or the possible bounce zones or support zones to enter your trade. Now the final tool I use in trading is moving averages, and it is one of the most commonly used technical indicators in forex trading. There are two. We have the MAs and EMAs, the SMA and the EMA, which is the simple moving average and the exponential moving average. No, you don't need to calculate these things. They are just tools on the charts. You can just go and get one there and put it to or add it to the charts. Now if you want to get moving average, you go to insert, then you come to indicators, then you go to trend, then moving average. Okay, now you can set the period for it. Then you can set the MA, whether it's simple or exponential. Then that is that. So I use 30. And we can make it red. Then let me increase this a bit. Then I'll add another. I use 30, 50 and 100. I learned this from a man called Hector DeVille. Hector calls this the 3 SMA method. It is a popular thing he created. Yeah, so sometimes I add it. I don't always use it though, but sometimes I add it to my charts. So we've got the 30. Let's go and add the 50. We go to indicators, we go to trend, then moving averages. 50. Let's make it, oh well, it's supposed to be simple. Oh, then let's change the color and make this a green. Okay, forest green is okay. Let me make it simple. Yeah. Then finally, let's add the 100, 30, 50 and 100. So go to insert again, indicators, trend, then moving averages. Then we type in the period, simple, change the color to say blue. Yeah, so this is our moving average on our charts. Now, so what does the moving average do? The moving average behaves almost like the trend line, because with the trend line we're able to know what the trend is doing, if the market is going up. So you realize that let me get a very nice one to explain this. Yes, especially you realize that in this area, let me remove the trend line first, increase this a bit. So you realize that in this area the market was bouncing on the moving averages. Okay, and with moving averages, when we find a bit of space in between the moving averages pointing in a particular direction, either up or down, then it is an indication of a strong trend, whether uptrend or downtrend. In this case, it's an uptrend. So what trend lines do for us, moving averages also do a similar job. You understand? So you realize that in this area the market bounced. There is another area the market bounced here and it's gone up. So sometimes I add the moving averages to help me to be able to follow the trend and to be able to get into the market along where the trend meets the trend line or the moving averages. In this case I'm talking about moving average, so where the trend meets the moving averages. You see, market goes up, comes to bounce off it, goes up, come to bounce off it, and it's normally advisable to wait for the second bounce on it. This first one is not advisable to take it, but on the second, the third, the fourth is advisable, because whenever the market bounce from there, it makes the moving average stronger to hold the market at a future date. Yeah, so that is about moving averages. Let's continue to learn something more. Apart from these things, another thing I want us to discuss is types of analysis. Let's quickly touch on this, but you can get more information on these types of analysis on babypips.com. They do a good job, explaining the types of analysis used in trading the forex market. So we have fundamental analysis. Let me just type fundamental. We have sentimental. Then we finally have technical, and that is what we'll focus our attention on. We have fundamental analysis, we have sentimental and technical. Now, when we talk about fundamental analysis in forex trading, we are looking at more of what we call macroeconomic indicators, talking about exchange rates, interest rates, and the general health of an economy. So that is the fundamentals. And so we normally, there's a website called, let me show you, it's called where is it here, forexfactory.com. Normally every day or every week there are some fundamentals that are released. The fundamentals has to do with economic indicators in economies. So all the major pairs, they have their fundamental news released almost every day of the week. So today is the 2nd of August. So this was the fundamentals that came were released during the day. Okay, it is already midnight here. Okay, it's midnight. You can see it's 12:03 a.m. here. So we had construction PMI on GBP, then we have the ADP non-farm employment change on the USD, and we had crude oil inventories on the USD. So depending on the impacts, in fact, this website, when the envelopes you see there are yellowish or like this color, it tells you the impact is a little, but if they are red like this, then you see the impact is huge. And sometimes it can cause massive movements in the market. When the fundamental, the news is released, traders will usually react to the news, so it causes massive moves in the market. A perfect example is the recent UK elections, when both Theresa May and the other guy, they couldn't win the election. This is what happened on the pound. That is it. There was this particular candle. This guy was the news, just one news. See how it dropped. Let me see the number of pips. Okay, 264. Okay, it came all the way down here, giving over 300 pips, 320 pips, just with one news, because of the outcome of the UK elections. And so that is fundamental. Now, in sentimental, we are looking at the overall market sentiment, whether the market is bullish or bearish, or it is sideways. Okay, so market sentiments, and we can use the chart to know the sentiments. You can see that let's go to the weekly chart of the Euro USD now. Euro USD. Let me go to Euro USD. Let me remove the indicator from this here. Go to the weekly chart and look at market sentiment from, when was this? 2014. You can see 2014 May. See that the market has been bearish, or was bearish, for a period of over or close to 1 year. So that is the sentiment. You can see that we were dropping, coming down. We were coming down. So you see, we're coming down. So the sentiment is bearish. That is the sentiment, or the tone of the market. Now let's go to technical. Actually, the sentimental and the technical go hand in hand. You see, the sentimental is telling us that the market is going down, but technical will help us to know high probable areas to enter trades. so that we can benefit from the downtrend that we see. Okay, we can benefit from the downtrend because the market has been dropping, coming down, so we call this a downtrend. So you see that when the market drops, it goes up a bit like this, it comes down, goes up a bit, then we came down like this. So that is the behavior of the market. And so technical analysis teaches where we can take advantage of this downtrend as the market is coming down, breaking lower and coming down. Technical analysis, what it teaches us what or where high probability areas to go in and trade the market. And the tools that I mentioned earlier on are what we use, or traders use, to know these areas or high probability zones to go in and trade. Okay, so we use these. Already you see our candlesticks, our trend lines can come in to help us also. Then you can use your Fibonacci to also follow the market. So when the market bounces, you see here 23%, it was holding it some time, so that could have been a sell around here. So but this is just to analyze, to just talk about the tools. Then you can also of course apply the moving averages also to know the possible areas to go in and sell, because if the market is selling, basically when the market, if you want to be a seller in every time, you wait for prices to go higher, then you sell. So when we drop down, we wait for prices to go higher, then we sell. Prices to go higher, so but in a buy scenario or bullish scenario, when the price is going up, we wait for prices to come lower, then we buy, and then it comes lower, then we buy, it comes lower, then we buy, in that order. All right, that will be all for this video. In our next video, we'll focus our attention on technical analysis, because that is what helps us to be able to trade the market as retail traders. And so in the next video, we'll zoom in into technical analysis and begin to learn about support and resistance and other things that will help us to trade the forex market. Thank you, and see you in the next video. Bye.